So looking at the put-call parity, so price of underlying stock plus price of put should be equal to price of call plus present value of exercise price. If you replace the stock price with the value of the firm as the underlying asset and present value of the exercise price with the value of default-free bond, you should get the following. Value of call on firm is equal to value of firm plus value of put on firm minus value of default-free bond. And the left side of this equation will represent stockholders' position in terms of call options, while the right side will represent stockholders' position in terms of put options. So to summarize the transformation from the first equation above to the second one, we treated the firm, not the stock, as the underlying asset. The value of the firm is the same as the price of the stock in that sense. And secondly, the exercise price is $450 million, which is the principal and interest on the firm's debt. Taking the present value of this amount at the riskless rate yields the value of a default-free bond. Thirdly, the order of the terms in the first equation is rearranged in the second equation. You should note that the left side of the second equation is the stockholder's position in terms of call options, as was shown in the table on the previous slide. The right side of the second equation is the stockholder's position in terms of put options, again as was shown in the same table. So put-call parity demonstrates that viewing the stockholder's position in terms of call options is equivalent to viewing the stockholder's position in terms of put options. Let's rearrange the terms in the second equation to yield the following then. So value of call on firm is equal to value of firm plus value of put on firm minus value of default-free bond. So value of firm will stay here, and then I will move value of call on the firm from the left side to the right side, and then value of default free bond will move from the right side to the left side, while again value of put on the firm will be moved from the right side to the left side. So then when you arrange the terms, you will end up having this equation. Again, left side will represent the bondholder's position in terms of call options, and the right side will represent bondholder's position in terms of put options. So the left side of the last equation above is the bondholder's position in terms of call options, as was shown in the table on slide 114, and the minus sign on this side of the equation indicates that the bondholders are writing or selling a call, and the right side of the equation is the bondholder's position in terms of put options, again as was shown in the table on slide 114. In summary, put-call parity shows that viewing the bondholder's position in terms of call options is equivalent to viewing the bondholder's position in terms of put options. Now let's have a quick look at loan guarantees. So in the Banzai example, it is evident that the bondholders are exposed to the risk of default. In practice, bondholders tend to demand an interest rate high enough to compensate them for the default risk. And furthermore, it should be also clear that firms experiencing financial distress cannot access debt at moderate interest rates. In such cases, these firms are likely to request loan guarantees from the government. The framework laid out in the previous example can be utilized to understand how these guarantees work. If the firm defaults on the guaranteed loan, the government will cover the difference. So government guarantee converts a risky bond into a riskless bond. How can we assess the value of these guarantees? On slide 113, we shared the following equation. Value of default-free bond should be equal to value of risky bond plus value of the put option. Remember, default-free bond is actually more valuable than a bond that is exposed to default or bankruptcy risk, because you may not be paid in full in that case. But if you have default-free bond, the possibility that you won't be paid in full is zero. So this equation demonstrates that the government is obliged to incur a cost equal to the value of a put option here. So politicians and company spokespeople may say that such a guarantee will cost the taxpayers nothing, so that such a claim facilitates the firm's ability to access debt, helping it stay solvent. Nonetheless, this equation says otherwise. And furthermore, solvency may be possible, but it is never certain. As is manifest in the equation above, the government's obligation has a cost in terms of present value whenever such a guarantee is made. To say that a government guarantee costs the government nothing is the same as to say that a put on the stock of Amazon has no value because the stock is likely to rise in. Generally, it can be said that the US government hasn't had any problems with loan guarantees. For example, biggest guarantees before 2008 financial crisis were offered to the Lockheed in 1971 and Chrysler in 1980. Both were on the verge of being cash-strapped and defaulting on their loans. For both companies, US government agreed to guarantee new loans. These guarantees would have allowed the lenders to obtain the full value of their claims from the US government if both firms had defaulted on new loans secured. So virtually the loans became risk-free treasury bonds for the lenders. These guarantees allowed Lockheed and Chrysler to borrow a large amount of cash and navigate through a difficult time. In the end, neither firm defaulted. There are two very salient points concerning loan guarantees. If existing risky bonds are guaranteed, all gains accrue to the existing bondholders, while stockholders will gain nothing because the limited liability of corporations absolves the stockholders of any obligation in the bankruptcy. And secondly, if new debt is issued and guaranteed, the new debt holders will not gain anything because in a competitive market they must accept a low interest rate because of the debt's low risk. The stockholders gain because they issue debt at a low interest rate and keep the firm afloat if it is distressed. Additionally, some of the gains accrue to the old bondholders because the firm's value is greater than would otherwise be true. Hence, if shareholders want all the gains from loan guarantees, they must renegotiate or retire existing bonds before the guarantee is in place. This was the case for Chrysler.